Do you know the difference between a mortgage pre-qualification and a mortgage pre-approval? This is one of the most commonly asked questions that I get every day. And I want to explain to you the difference between the two. And also, I want to share with you a story about a client that wanted to take a few shortcuts, and we'll see how this ends up. Now, the difference between a mortgage pre-qualification and a pre-approval, a pre-qualification, for the most part, a lender is going to take an application or they're going to get information from you simply over the phone. More often than not, they're going to ask you the basic questions like, how long have you lived at your current residence? Are you paying rent? Are you living with family? Or do you own a home? How long have you been at your job? How much money you have in the bank account? And how much house you're looking to qualify for. Now, when you look at a pre-approval is when a lender will pull your credit and then they're going to verify your information. So they're going to ask you for the most basic documents that every loan officer should ask, which is 1 month of pay stubs, 2 years of tax returns and W-2 forms, 2 months of bank statements, and a copy of your driver's license or some sort of photo ID. That's the bare minimum that any lender should ask you for when it comes to a pre-approval. Obviously, if you own other properties, there could be mortgage statements that they will request, insurance declaration forms, HOA statements. The list can go literally on and on and on, depending on how complex your file is. But at a bare minimum, those are the documents that you should need. Now, the difference between the two is obviously the pre-qualification. Nothing's really being verified. You as the borrower are telling the lender everything that they're asking you. Now, you can obviously withhold information or not disclose certain things because maybe you've talked to a lender or two and maybe they said you can't qualify. So if you're answering the questions simply to get a pre-approval letter, you could actually hurt yourself in the long run and cost yourself thousands of dollars. I don't recommend doing a pre-qualification. To me, that's a shortcut. Does it work for some? Yes, but I have horror stories upon horror stories over the last 15 years of my career that I've dealt with people that tried to take a shortcut that have only had the loan come back to bite them in the butt at the end. Now, with a pre-approval, like I mentioned, the loan officer is going to verify everything. And to me, that's the proper way to go about buying a house. You want your lender to look at your credit because if you're not serious, then you're literally wasting everyone's time. If you're serious about buying a house, having your credit pulled is the absolute first step. As an investor myself, I go through the process and I go through the exact same process that I'm describing to you. When I bought my rental properties the other year, I had my lender pull my credit. It didn't matter if it was a soft pull or not because that is part of the process. And if you're unsure about what your score is, I would check with a website like Experian.com just to get a ballpark of what your credit score could potentially be. Now remember, Credit Karma and Credit Sesame and some of these other consumer sites that are out there, they're great for having information on your credit. But when it comes to your credit score, remember, those scores are probably going to be inflated than what a mortgage lender is going to look at when we pull your credit report. I've seen the difference between anywhere of 50, 70, even 80, 90 points. So depending on what's being reported, how it's reported, remember, if you're looking at Credit Karma, that credit score is going to be higher than what a lender pulls when they look at your credit report. Now, let me ask you this question. If you are a seller selling your home, would you rather take a pre-qualification letter or would you rather know that the buyer got pre-approved with a lender, they've verified everything? Think about the market that we've been in the last couple of years. There's extremely low inventory. Houses are flying off the shelves. There's multiple offers. So if you were the seller, would you rather take an offer that nothing's been verified and hopes that maybe the house will close? Or would you rather know that everything's been verified? Of course, you'd want to know everything's been verified. That's why I strongly suggest you get pre-approved. Now, let's hop into my story about a client named Jeff. Jeff was looking to relocate from California, like most of you that watch my channel, so thank you so much. Oh, and by the way, if we haven't met, my name is Seanu Uyehara. I'm a branch manager with Loan Depot, helping you finance your homes all across the country, whether you're thinking of purchasing, refinancing, buying a vacation home, or you're a seasoned investor looking to build your real estate portfolio, I've got you covered. You can always hit the description below for links to more information on how to get your mortgage right. And of course, I always ask if you can subscribe to my channel and make sure you hit the thumbs up because it tells YouTube that you like our videos. Now back to my story about Jeff. So Jeff was relocating from California. He had reached out to us and he was looking to make his move within the next 6 months. When I initially spoke to Jeff, he was a business owner. He said, he makes a few $100,000 a year, which is great. He did have another property, which he was intending on selling. So obviously we'd free up some debt for him when it came to that. And he'd have some cash that he'd be using towards his down payment. So on the surface, Jeff sounds like an amazing client. He probably makes 200, 300, 400 grand a year. He said he had amazing credit and he had little to no debt. Great. The average loan officer would have issued a pre-qual letter because it sounds good. He checks all the boxes like I mentioned, the credit score, the income, the debt, and he's selling his house and he's making money. So what could go wrong, right? Everything sounds picture perfect for a client. Now, let's fast forward a little bit. Jeff did not want to have his credit pulled, and Jeff did not want to provide me any of his documentation. So I hard pressed him for the information because I said, Jeff, you are self-employed. Self-employed borrowers typically have a tougher time qualifying simply because your gross revenue or your gross sales that you bring in is a completely different story than what it shows as your net. And I do have a few side businesses that I own myself, as I have a few e-commerce stores and businesses that I run. Trust me, the top line number is completely different from the bottom line. So I get it. But when it comes to being a self-employed borrower looking to purchase, as a mortgage lender, we're looking at the net income. So when I finally got Jeff's information, because I had help from his real estate agent encouraging him to get us his information simply because, like I said, he was self-employed. When I finally got Jeff's credit report, guess what? His score was 40 points lower than what he thought it was. Then I got his tax returns. And this is where the bombshell drops. You ready for this? He told me he made $400,000 that year, but guess what? He actually had a loss of $300,000. Jeff's business showed that he made absolutely no money. Not that he didn't make any money, he actually lost money. So when it came to look at qualifying for the mortgage, we couldn't get him approved. That is why it is so important to make sure when you get with your lender, you get pre-approved. Because if I would have took the shortcut and issued the pre-approval letter, and if you've been watching my channel, you know that I've actually made that mistake once. Jeff would have shopped for the house. Let's say he would have got his offer accepted. He would have probably spent a few $100s on a home inspection. He probably would have wired in, I would say for the price range of what he was looking for, maybe at least $5,000 worth of earnest money. He would have probably paid for an appraisal, which could have been another $500-600. So Jeff would have probably came out of pocket $5,000-6,000, maybe even including travel expenses from California to Las Vegas to where he was looking to purchase, only to find out in the 11th hour that maybe we couldn't even qualify him and he would have potentially lost those funds because, as you could imagine, if you were the seller, would you want to give the buyer back their earnest money deposit knowing that the loan just fell apart because the lender didn't do their job up front? That's always a big frustration when it comes down to the end. And trust me, I've seen agents fight about it to where they have to go to court to try to get the money back. So that is why I always stress to get pre-approved. You want to make sure your lender is verifying everything. Because as a lender myself, the last thing I ever want to do is tell my clients that your loan's denied or, hey, we missed something and we can't get you approved for financing. We want to make sure we do all of our due diligence up front to avoid situations like Jeff. Now, unfortunately for Jeff, we couldn't qualify him for what he wanted. He now had to sign a lease for another year. And guess what? You all know what has happened to the real estate market over the last year. Prices have gone up. Interest rates have also gone up. So you have to remember, as a mortgage lender, we are not here to make your life difficult. We want to make sure that we get you into a house as efficiently as possible, because if anyone misses the ball up front and you had to wait like Jeff, guess what? That $400,000 house that he was looking at, it's probably worth $450 now. And the interest rate that we could have got him last year, it's higher now. So not only is his payment going to go up, he's going to have to put more money down when it comes to buying the house. And now when you look at the interest that's paid over the life of the loan, he's going to pay more money because the interest rate is higher. These are all the factors that we're taking into account when we talk to our clients up front. Again, I want to make your life as easy as possible to get you into the home and show you your options and make sure that we're all on the same page to make it an enjoyable experience. And if you still have questions about how to get your mortgage right, remember, you can check out my playlist right here or hit the description below for links to more information, and I'll see you on the next video.